Great stuff. So what are we going to do when we do companies? At the end of this module, and it's a fairly long module, you must know what is a company. You must know that there are different types of companies and how do you distinguish between them. You must understand the basic principles and procedures of forming a company. You must know how a company actually gets hold of capital. You must understand what is a shareholder and what is the rights of a shareholder. And then obviously we're busy with accounting. You must be able to record transactions specific to shareholders where we are talking about the issue of capital, the changes in share capital. Now, what kind of changes? Well, we can convert shares, we can redeem shares, we can do buy back shares, we can issue new capital, we can do a capitalization issue, we can do a bonus issue, and all these things that sounds a little bit Greek to you right now is going to be quite familiar by the end of the module to yourself. You must know what a dividend is. You must know how payments of dividends are taking place. And then we have a new animal and another type of tax that we have in this lovely country of ours that we call dividend withholding tax. Yet another one that we are going to pay the taxman a portion of our income. And then retained earnings and reserves, what is all included in those items, how are we going to determine that, how are we going to calculate that, and then obviously how are we going to disclose these kind of transactions, number one, in the statement of changes in equity, and then number two, obviously we're busy with accounting, how is it going to look in the financial statements of a company. Now, the first thing that we have to do is to tell you what type of companies do we get. Now, the first category is profit companies, and then obviously on the other side of the coin, non-profit companies. Now, as far as I'm concerned, the only reason why you want to go through the trouble in order to have a company is because you are going to make money and profits, and that is the only reason. A non-profit company, as far as I'm concerned, well, there's definitely space for that in this community that we're living in, but that should be the exception and definitely not the rule. So under profit companies, what type of companies are we talking of? Now, the first one is state-owned companies, and we do not definitely want to talk too much about state-owned companies. There we are talking about companies like Eskom, SAA, Transnet, Denel. We can have a whole list of them, and all of them have some kind of financial difficulty at this point of time, and there was some kind of corruption that took place there, so we do not want to wander down this road. All you have to know is that you have a state-owned company, which is a profit company supposed to be. The second one is a private company. Now, whenever you see the words Pty Limited, those Pty Limited is an indication that you are talking about a private company. A state-owned company, the closing words is SOC Limited. So it's a state SOC. Fine, okay. Right, so a private company, that is that can have an unlimited number of shareholders, but the whole idea is that the private company is your actions a little bit limited, and therefore you're obviously not going to have quite a big company organized as a private company. Then you would rather go to a public company, which we are going to talk about a little bit later. The third profit company that we get is a personal liability company, and the closing words of such a company is Inc. Now, in a personal liability company, we're going to talk about more about all these companies a little bit later on. But a personal liability company, in short, is where the directors of the company is jointly and severally responsible for the debt and the commitments that that company has entered into. So, yeah, we will speak about that a little bit later on. Then a public company, and that is probably the most general type of company. A public company is everything which is not a state-owned company, a private company, a personal liability company, or a non-profit company. And you will see that that is a popular company. It can be either a listed company or unlisted company, but we will talk about that one a little bit more as well. Then we get a so-called non-profit companies, and we categorize them all under Section 21 company. And then you will see that the closing words of that company is NPC, non-profit company. Now, just in short, we will talk about that a little bit later on as well. Why will I have a non-profit company if I'm going to service the interest of the community? Then that would be a way to go in order to do that. So let's have a look here. What is a private company? Well, the first thing is it's not a state-owned company. The memorandum of incorporation, that is MOI. The memorandum of incorporation prohibits the offering of securities to the public. Now, what is memorandum of incorporation? Guys, that is the user manual of the company. That dictates what he can, what he can't, what he must, what he mustn't, and how much he can, how much he cannot. So it's like the Bible. It is actually, it's a guideline and an instruction manual of what is allowed in that entity and what is not allowed. Now, the first thing of a private company is that the shares of a private company is not freely transferable to another party. So let's say that I have a share in a private company and I want to sell my share in the private company. I cannot just go along and sell my shares. No, I first have to get the permission of the other shareholders before I can actually sell my shares. And then they also have to approve the new shareholder that's going to take up my shareholding in that entity. There's no limit of shareholders. So in the old days, there was a limit of 50 shareholders. There's no limit anymore. So it can be any number of shareholders. And then the shares itself we're going to issue is going to be no par value shares. But we are going to talk about par value and no par value shares a little bit later on. A personal liability company, now that meets the criteria of a private company. The memorandum of incorporation states that the directors and past directors are jointly and severally liable together with the company for the debts and liabilities that were contracted through their respective terms. Now, you were still, I would say, in the beginning of your high school career when this whole Gupta thing actually exploded. And one of the big audit firms were quite exposed in some of the transactions there. And actually what happened is that the top structure of that specific firm had to resign and they had to appoint new people in that position. And although there is not a lot of legal action that has taken place as yet against the guilty parties and the audit firm, potentially those partners or those directors of the audit firm at that point of time was involved in some of the reports that was issued on some of these matters where everything was not 100% kosher. Now, potentially, they can be held liable with the firm itself for any wrongdoings and for any damages and for any losses that was actually suffered by third parties. So, a type of businesses that actually like to be a liability company is, for instance, audit firms, legal firms, Weber Wenzel, those big legal firms, Denise Rates, all those big legal firms. They're also in companies. And why? Because there is not a lot of difference between the directors of the company and the owners of the company, the shareholders of the company. They are actually exactly the same people. So the directors and the shareholders, then by implication, is very much involved in the day-to-day operations of this company. It is just better for them to organize the administration and the way they conduct business in a company opposed to a partnership, or then obviously it can't be a one-man band. And closed corporations, guys, let's talk about closed corporations. You haven't seen closed corporations here anywhere. Why not? Because from 2008, the New Companies Act has prohibited any new closed corporations to be registered. It says existing closed corporations, they can remain and they can continue to operate and they don't have to close it, also convert into a private company, because that's the way to go. If you want to convert your closed corporation in a company, you will convert it into a private company. It says, but you don't have to do that. He says, but and all the old rules and regulations, there was a whole act on closed corporations that is still applicable, and they still have to adhere all those rules and regulations. He says, but no new closed corporations since 2008 could be registered. Where do I register a company? Now, we'll see a little bit later, we're going to talk about that as well. And there is an entity that actually belongs to the state, SIPC. And you have to register your company at SIPC before you can start operating like a company in this country. Now, what is a private company? Yeah, that is any other company. You need at least one shareholder, and that can be either a listed company or an unlisted company. Now, what does that mean in plain simple English? In South Africa, we have two stock exchanges, one being the Johannesburg Stock Exchange, as old as the mountains itself. That is the biggest stock exchange. But since about 3-4 years ago, we also have a second stock exchange in South Africa. We call it the Alt2X exchange. And the market listing on this new exchange has grew quite substantially over the past 3-4 years. We have large corporations like Naspers, for instance, that is listed on the Alt2X, and it is the reason for that is it's much cheaper to trade in shares on the Alt2X than on the JSE. But I mean, what does it mean to be listed? It means that the shares of a company is listed on the stock exchange, and any person can either buy shares, and if you are the holder of shares, you can sell your shares via the stock exchange by making use of a broker or bank or something like that. An unlisted share, to the contrary, is obviously a share that is not listed on a stock exchange. So it can still be a public company. The only difference is that my shares is not listed. Now, the big difference between a public company and a private company is that in a public company, I can transfer my shares freely. So if I'm the holder of a share in a public company, I can sell it to any person, and any person can become the shareholder of a public company. A Section 21 company, now let's talk about that. I think in South Africa, we have a wonderful example of a Section 21 company, and that is Gift of the Givers. Now, Dr. Suleiman and these boys, they are doing a lot of good work right across the world, not only in South Africa, not only in Africa, right across the world, wherever there is a lot of need and there is a lot of hardship, they actually jump in and they come to the rescue of those people. So what do? They actually have to make use of donations and food and clothes and whatever means of donations that they can get hold of. And what do they do with, and money obviously. And what do? They use that money that they're going to receive by ways of donations, and they're going to purchase all the stuff needed in order to help wherever their help is needed. So yeah, it is all about social or cultural activity and communal group interest. So all that money that they're going to raise is going to be plowed back into the community eventually. This is Afrikaans. Now what is a public? I think I've skipped one. What is a private company first? Now, you have to apply, doesn't matter what kind of company you're going to register, you have to apply for registration with SIPC. Now, SIPC stands for the Companies and Intellectual Property Commission. Now, every year you have to submit some documentations and your financial statements to SIPC. And obviously, before you can submit, you have to pay a little fee. Like everything in this life, you have to pay before you can do anything. So that is what's happening, and that is the reason why SIPC is there. They also make sure that companies do actually compile financial statements, and they make sure that when a company is registered, that they actually fulfill all the rules and regulations associated with that. Now, we've already spoken about the Memorandum of Incorporation. They say that is how the company should operate. So we, in a private company probably, let's say we have developed a software package, and this is going to turn the world around upside down, and we want to go big, but we don't have the money to expand any further. So because I'm this absolute fundy on software development, I will probably go to other software developers and ask them whether they don't want to invest in my company. So I target a certain group of people who I think could be potential investors and would be interested to invest in my company, and I will ask them whether they don't want to take up any shares in my company. Now, I can make use of intermediaries like banks or brokers or people like that. Maybe the bank will know about interested parties who they can, on my behalf, then ask whether they would like to become an investor in my company or not. So, the big thing is once you are an investor in that company, so you're a shareholder, you cannot sell your shares to anybody. You have to inform your fellow shareholders first of your intention of selling your shares. You have to offer your share to those existing shareholders first, and then if they don't want to take up the shares, they have to approve the new shareholder who you are going to sell your shares to. Very important is all companies are legal persons. Now, what does that mean in plain simple English? According to the law, a company, once you are a company, you are a person. Now, you don't have two legs, you don't have a head, you don't have arms, you don't have anything, you can't breathe. But in the eyes of the law, you are seen as an entity that can operate on its own. So therefore, he says you, as a private company who is actually a person, in inverted commas, you are liable for your own taxes. So therefore, based on your total profit for the year, all companies have to pay 28% of their profits away to the receiver of revenue for income tax. He says, so you are responsible for paying your own tax. If you can remember back to a sole proprietor, what does a sole proprietor do, and a partnership for that matter? The portion of profit that the sole proprietor has made, so if the sole proprietor has made 100 Rand profit, that 100 Rand profit becomes part of his income and he's taxed in his personal capacity as the owner. Let's say ABC, Mr. ABC. He will be taxed in his personal capacity on that profit which belongs to him. But in a company, the company makes a profit and the company is taxed at 28%, and the company is liable to pay over the tax to the receiver of revenue. The company as a legal person is also responsible for paying its own debts. So they have to honor their own commitments. If the company owes the bank 100,000 Rand and they fail to pay the bank cannot come to the shareholders and say, listen, pay up on behalf of the company. They can only go to the company because that's a person on its own right, and they can ask the company in order to honor their commitments. There is an exception though, and that you get very often with private companies where there's quite a close relationship between the shareholders and the management of the company. And that is maybe it's your own company and you are shareholder and director of the company and you are managing the business of that company on a day-to-day basis. Now, there you can actually go and you can sign suretyship for the debts of the company. Now, once you have that document signed, then it means if the company fails to pay its outstanding debt, the person who you owe the debt to, so the bank in our example, can then come to you and say, listen, we have a suretyship agreement, and according to this agreement, you are liable for the debt of the company if the company fails to repay the debt themselves. A public company, it has exactly the same characteristics, but it can raise capital from the general public and the shares are fully transferable. So I can sell and buy as I wish those shares of the company. Now, how does the company raise capital from the general public? They're going to issue a prospectus. I'm going to talk a little bit more about prospectus in the next video, but they invite the general public to apply or to subscribe for shares in a company. And then the Company Act, this is a very big document, it's a very important document, and there's a lot of requirements surrounding a prospectus that the company has to adhere to. And the Companies Act actually prescribe what kind of information must be included in this prospectus, and then obviously no misleading information must actually be presented in such a document. Now, here we say where are the shares listed? It's on the JSE and the AltX, Alt2X. Unlisted shares means it's not on any stock exchange. The shares is not listed on any stock exchange. Right, then subsidy you have to have in certain instances, if you are a big company, there's a PIC score which determines whether you must have audited financial statements. So depending on that, the bigger you are and the more complex your transactions are, you have to have, according by law, an auditor, and your financial statements must be audited on an annual basis. And those annual audited financial statements must then be presented to subsidy, and that is then available for inspection by the general public. A public liability company, we say here the directors are jointly and severally liable with the company for the debts and liabilities, and kind of professions that like to be organized in a public liability company are things like attorneys and accountants. And state-owned companies, well, the lesser we say about them, the better for our own health. The personal liability of directors, guys, in a company, we have shareholders, but the shareholders are not involved in the day-to-day operations and the management of the company. They appoint the board of directors, and the board of directors are responsible for the management on a daily basis of the company. So for entering transactions, for developing strategy and all those kind of things, that is the responsibility of the board of directors. Now, all this liability, all these tasks and all the requirements that the directors have to adhere to, that has been set out in the Companies Act, and then in the past number of years, quite a number of years now, we have something that we call the King Report, and I think it's now the King 5 report is already out, and that is all about good corporate governance. So what must I do? How must I achieve a sound and good run company where there's no funnies going on, where there's no corruption going on, and where everybody actually plays according to the rules, and then ensure that the company is a healthy, governed type of company. Now, in the King Report, there are pages and pages of how a director must actually act and what his responsibilities are in order to take reasonable care of that company. What is important is that there must never be a conflict of interest. So if I am on the board of directors of ABSA, for instance, I cannot be on the board of directors of Standard Bank as well, because they are actually competitors with each other. So whose interest am I going to look after? Am I going to look after ABSA's interest? Isn't that going to be to the detriment of Standard Bank's interest and vice versa? So therefore, when I am serving on a board of directors, there must be no personal conflict of interest, and I must take reasonable care that I'm going to further the company's rules, its goals, and then also going to contribute in making this company a good run and profitable company. Now, according to the Companies Act, there are 3 classes of shares. Now, according to that, we're also going to do the accounting stuff, but slightly different from the Companies Act. Now, according to the Companies Act, you have a Class A, Class B, and a Class C share. A Class A share, now that is the top of the list. That is the share potentially who has the biggest return on the share. That is the most important share, and that is actually the shareholder, the owner of this company. Why? Because an ordinary share has voting rights. What do we want to vote for? Guys, there's something that we call a general meeting, and the general meeting has to happen at least once a year. That's the annual general meeting, and there on those meetings, the shareholders are actually approving certain important things. They also appoint the board of directors. They they appoint the auditors, and they approve on those meetings also the financial statements of this entity. They can also vote there if there's very important strategy changes that the company envisages doing. They can give their approval to that. So they are really, these guys are the real owners of the company, although they are not involved in the day-to-day operations of the company, but they approving or they appointing the board of directors who actually are involved with the day-to-day operations. Now, not only do they have voting rights, they are also entitled on distributions. Now, what kind of distributions? Income distributions. So when a company makes a profit, they are entitled on a portion of that profit that the company has made, and that is what that distribution takes place by way of a dividend. So they're entitled on a dividend, and then if liquidation of the company takes place and there is something left after everybody has received their portion that they're entitled on in the company, they can get whatever is left, and that is distributed amongst these ordinary shareholders. A Class B share is a preference share, and you will see something like a 10% preference shares. Now, these shares do not have voting rights, but they have another benefit. That 10% is the indication of what is the amount of income distribution that should actually happen on an annual basis and paid out to them. So it's a fixed distribution, in this case of 10%, of the amount that they've invested into this company. And then before the company can actually declare a dividend to the ordinary shareholders, they first have to pay these preference shareholders their 10% of the capital that they held in this company. A Class C share is like a redeemable preference share. Now you'll see preference shares, but a redeemable preference shares, and certainly all the redeemable preference shares that you are going to come across in this year, is something, it's a share, but it is more of a loan type of nature. Now, obviously no voting rights. Obviously, 12% means that they're entitled on an income distribution of 12%. And that would be before the ordinary shareholder again is standing in line for a dividend. And the only thing is, because this shares is redeemable at the option of the company somewhere in the future, it means that it is like a loan because they receive finance, capital, they can use the capital, but somewhere in the future they have to pay back the capital. And that is why I'm saying that is a Class C share where that equity needs to be paid back. And you will see this year that if a redeemable preference share has certain characteristics, we actually, out of an accounting perspective, do not even classify that as equity. We classify that as a non-current liability. Authorized and issued share capital. Now, in the Memorandum of Incorporation, the maximum number of shares and the classes of those shares that is available for issue, that is actually set out. Now, there you can see, for instance, this company can issue 500,000 ordinary shares, 200,000 10% cumulative preference shares, and 5,000 12% redeemable preference shares. So for each class, ordinary shares, 10% cumulative preference shares, 12% redeemable preference shares, each one of them is a class on its own, and for each one of them, there is a maximum number of shares specified in the MOI, how many shares they are allowed to issue. And that is what we call authorized share capital. And that is different from the actual number of shares per class that was in actual fact already issued. Now, the actual number, that is issued share capital. Now, think a little bit further. What are we going to account for in accounting? The authorized or the actual? Obviously, the actual. So, as part of our equity, it's not going to be the maximum, only the actual number of shares. However, you are obliged by the Company Act to disclose to the reader of the financial statements what is the maximum number of shares that the company is allowed to issue somewhere in the future. Right.
Issued shares are the amount of authorized stocks a company shareholders buy and own. The annual report shows the number of outstanding issued shares a company has. Issued shares are the stock a company sells to raise capital. They're also the stocks insiders receive as part of their compensation. Shares a company retires are not included among its issued shares. Authorized shares are all of the stocks a company is allowed to issue, but dividends are only paid on issued shares. For example, a company may authorize the sale of 100,000 shares, but only sell 75,000 and retain the rest in its treasury. When a company issues additional shares, it raises more money, but it also increases the number of shares outstanding, thus decreasing or diluting the value of the shares that were already owned. Companies sometimes buy back outstanding stocks and add them to their treasury. Doing so serves to increase the value of issued shares, and it often replaces a dividend payment.
Good. So companies, there's quite a lot involved in companies. I'm going to break it down in smaller videos so that you can have a look at all the individual videos and familiarize you with the share transactions that takes place.